Hello and welcome to Cafe Mutual YouTube channel. Friends, popularity of passive funds have been growing by leaps and bounds. In fact, the AUM of passive funds has recently crossed 8 lakh crore, which is around 16% of the total AUM. So to help us understand more about passive fund, today we have with us Arun Sundaresan, head ETF Nippon India Mutual Fund. With over 20 years of experience in financial services industry, Arun has played a key role in making passive investing popular among investors. So without wasting time, let's call him. Welcome to the show, Arun.
Thank you, Nishant. Thanks for having me on the show. Looking forward to interacting with the users.
Great. So Arun, we would like to understand how will you simply explain what is passive funds and how it is different from active funds?
So, very simple. So, in an active fund, there is a fund manager who takes active call on which stocks, or for that matter, which securities, in the case of debt passive funds, which ones to buy at what point in time. So, that decision he or she would be making based on their own assessment, research, etc. So, the portfolio composition and therefore the eventual risk and return of the fund could vary. If the fund manager does a good job, which you will come to know on hindsight, so obviously the returns will be very good. On the contrary, if the decisions go wrong, your returns could be poor. It could be lower than the market. So these are active funds. Passive funds are simple. This element, this part where the fund manager actively picks up securities, that is not there. Passive funds simply replicate a predetermined index. Suppose if it's a Nifty ETF or a Nifty index fund, you know there are 50 stocks, you know this is the composition. The fund will simply replicate. So there is no active call as to let me buy more of this, let me sell this particular stock, this security. Those elements are not there. Therefore, what you get, and therefore the essential benefit of passive investing is you play the market, you invest into the market. There is nothing more and nothing less about anything else. So that's passive investing in simple terms.
Okay. So let's say if I have 100 rupees and I want to buy Nifty 50, my 100 rupees will be divided into the all 50 stocks in the proportionate value or equal weight. How it works?
So basically, it will depend on the type of index. So Nifty 50, for example, is not a equal weight index. So there are 50 stocks. It does not mean that 2 rupees will be invested in all 50 stocks. It's a cap, market capitalization based index. So accordingly, one stock could be having a weight of 12%. There is another stock which could be 5%, and so on and so forth. Having said that, as an investor, you will be investing exactly as per the index. In a way, passive investing is a rules based.
Okay.
You predetermine the index is constructed. You know what you are getting into. There is nothing different beyond what is already defined. So that's the best part of index. You know what you are getting into. But of course, depending on the various types of passive products, the construction, the methodology can be different. There is also a Nifty 50 equal weight index.
Hmm.
So if you select that, then your 100 rupees will be equally divided.
Okay.
So how exactly it will get invested will depend on the type of index, the methodology. But the passive investing per se is replicating the index and not taking any differentiated calls.
Okay. Got it. Got it. So Arun, but what are the primary advantages of passive funds?
So I would say the main advantage is, suppose as an investor, you're very convinced about Indian markets. Let's say that you're quite clear that Indian economy is growing very strongly, and that eventually will reflect in the market returns. And you want to play that story, right? You want to invest into Indian equities, and then you say that Nifty 50, for example, is a good representation of Indian markets. So probably it accounts for something like 70-75% of the entire market. And that's good enough. So I want to play the Indian growth story through equity, through Nifty. If you have made that decision, investing into a Nifty ETF or a Nifty index fund becomes a good choice. You need not necessarily figure out which particular fund should I invest into. Should it be of this fund house, that fund manager? That is an additional element of risk and return. As I said, if your original endeavor, if your only limited endeavor is to play the market, might as well invest into the market, and you need not dabble with which fund manager at what point in time. As I said in the beginning, if your call is right, if the fund manager eventually does well, probably you earn more returns than the market. But the reverse is also, if not equally, probably more true. You could also be wrong, right? So your attempt, your endeavor is to earn market return, but sometimes you may end up underperforming the market because the fund manager took wrong calls. Do you want to do that? On top of market returns, do you want to add an additional element of risk and return? That is up to the investor. So this is the primary benefit of investing into passive. You are playing the market, nothing more, nothing less, as I said, number one. And second, cost also tends to be relatively lower when compared to active funds. So typically in India, the active funds tend to be 1.5%, sometimes even 2% costlier than the passives. Now, 1.5-2% might look like a small number. What if I tell you that probably in a given year, you could get, let's say, 15% return from Indian markets on a long term sustainable basis? 1.5 or a 2% is actually 10% cost, right? Now, 10% cost, would you pay extra to get into something which you're not very sure about upfront, where there is also a possibility that you could get suboptimal returns? That's a choice that you need to make. So those are, I think, two big advantages of passive investing.
So, Arun, for benefit of our audience, what exactly is market index and why it is critical component in the world of passive investing?
So in passive investing, as I said, everything boils down to replicating a particular index, which the investor knows upfront. So all this while we've been talking about a Nifty index, which is a market cap, and in this case, a large cap or a very large part of the market. So if you, on the other hand, want to invest into the smaller companies, there is a small cap index. So you can go and choose those funds, right? Likewise, if you want to invest into a select sector or a theme, for example, you like banking as a sector, you can go and invest into a banking ETF or a banking index fund. Likewise, if you say that I like the consumption story. India as a consumption theme should do very well. So I like that theme. There may be strategies. The commonality in all of these is that all these are rules based. You will know the index composition, how they rebalance. Everything is known upfront. It is there right in front of you. You decide, saying, this is exactly what I want, and then you go about investing. Therefore, it's very, very important to know what that particular index is, and that in itself, and that is in fact the only thing that actually matters. And you will have to match, as an investor, you will have to match your requirements with that particular strategy, which replicates a particular index, which is defined upfront.
So, Arun, many investors have heard of, when it comes to passive, they have heard of ETFs and index funds. So, can you break down the key difference between these two options and their respective advantages?
Sure, Nishant. So exchange traded fund or ETFs, right? So they're like any other, let's say, a stock or any other instrument which is traded on the exchange. So you have a particular stock, you want to buy and sell that particular stock in the exchange, you do that, right? This is no way different. This is, instead of one stock, it's a portfolio of stocks,
Okay.
which is combined in a particular manner as per the index methodology, and then it is listed on the exchange. You can buy and sell like how you do any other stock, right? So it's very, very similar. At the same time, there are also additional means by which you can transact, but they come with special conditions. And not for all investors. You need to have a minimum 25 crores and above, in which case you can directly transact with asset management companies. You can go and buy or sell directly instead of the exchange, but that's only a small part. But otherwise, the main advantage of exchange traded fund, you need not wait at the end of the day. You will appreciate with me, particularly in equity, the markets tend to be quite volatile. There can be times where from the time market opens, during the mid of the day, it could be 2% up. And at the end of the day, it could end up, at negative zone. So ETFs actually allow you the opportunity to trade anytime during the day. You think that middle of the day, 2% market up, it's a good level. You decide to sell, you sell, right? So you get market related intra-day, during the day kind of pricing, which is a big advantage. And especially given that during the day, the market movements can be very significant. That's a good advantage. So this is about exchange traded fund. Very simple. Think of it like any other stock, but it's just that it's a set of stocks and very convenient, very liquid. You just transact like you do any other stock. This is ETF. So for ETFs, you need demat account for you to transact through the exchange. If you do not have demat account and want to trade through the exchange, then there are index funds. Essentially, they do the same thing. They replicate the index. However, they do not allow you during the day or intra-day transaction. All your transactions will be at the end of day NAV, just like any other mutual fund. The only difference between index fund and mutual fund, like I said, is this is again rules based. It doesn't take active calls on which stock to add, which to sell, etc. Investment will be at any point in time as per the index, but you transact like a normal mutual fund at the end of the day,
Got it.
right? So that's the difference.
Arun, moving into a bit more detail, can you elaborate on what tracking error is and how it impacts the performance of passive investment relative to its benchmark?
Sure. So basically, when you are investing into a ETF or a index fund, essentially you are trying to get the same returns as the underlying index. So suppose you are investing into Nifty, your return should also be similar to Nifty. Your index return or ETF return should also be similar. But practically, it will be slightly different. One, of course, there are elements like cost. Then there are operational things like when you execute, the pricing could be slightly different. Okay, so end of the day, the actual index performance and the fund performance will be different, but ideally it should be only slightly different. It cannot be very different, right? So measuring that in a way is tracking error. So technically it's called as the standard deviation of the difference in return between the fund and the index. But don't worry about the technical definition. What we are saying is how different is the actual return, right, when compared to the underlying benchmark, and over a period of time, how volatile this difference has been. So that measurement is tracking error. Lower the tracking error means that the fund most times has been closer to the index. If that number is relatively high, it means that the fund's performance is different, and over a period of time it's volatile. The fund performance is all over the place when compared to the index, so that's not desirable. So tracking error should be relatively on the lower side. That will convey that the fund is consistently closer to the index returns. So that's the concept of tracking error.
So, talking about liquidity, especially in the case of ETFs, how do passive funds manage liquidity and what factors should investor consider regarding a trading cost?
So liquidity is very, very important, and a lot of investors who are directly dealing with stocks would be able to understand and appreciate this. So if the liquidity is generally very good, and you see a particular price, which is getting transacted on the exchange, you give an order for buy or sell. your execution will be closer to that particular price if the liquidity is reasonably good. If it is not, right, if the stock is relatively low on liquidity, there is hardly any trading that is happening, you will have a high impact cost, meaning the actual price that could be getting reflected in the exchange could be something. Your actual price buying or selling could be very different. It sometimes could be 2, 3, 4% different from the actual price that is getting displayed in the exchanges, right? So the same concept that happens in ETF. So the ETF is listed on the exchange. The more the liquidity, which means that actively investors are trading in it, buying, selling on the exchange, more the liquidity, the index will track very closer to the actual prices which are getting transacted. If the index is, if the ETF is less liquid, meaning a less number of people are transacting, the impact cost will be very different. So you will actually end up transacting at a price very different and suboptimal to how it is trading on the exchange. So this is something very, very important to keep note. So therefore, as an investor, when you're considering, let's say you're investing into a Nifty ETF and you're considering there are 4 5 Nifty ETFs, which ETFs should I go and invest into? Most ideally, you should select an ETF which is having the highest volume, or the volume is generally higher on a day-to-day basis or on a over a period of time. So those details are available on the stock exchanges. So just like how when you normally invest, you compare different fund portfolios, their track record, performance, you can compare liquidity, and generally, ideally, you should opt for those funds where liquidity is generally high. There are certain back-end things. I do not want to bore the listeners with those things. Like, there are technical aspects like how we manage to keep liquidity reasonably high. Things like, there are market makers and authorized participants who, at the back end, provide liquidity. So if there is buying, they will be counterparts, they'll be selling, and vice versa. But that's just one part. Market participants are just one part. There should be natural buying and selling. Only if that natural liquidity is quite high will the liquidity start getting enhanced, and therefore impact cost will be on the lower side. So this is very, very important when it comes to ETF investing particularly, because unlike mutual funds where everything gets transacted at the end of the day, and the mutual fund ensures there is a one NAV, everybody gets the same thing. In ETF, it is not that. It depends on the amount of the volume that you do and how it gets absorbed in the whole system. That's very, very important.
Got it, got it. So one last question, Arun. Can you elaborate about your popular Victor framework in passives?
Sure, Victor. It's not a common terminology. That's a terminology that was, coined by one of the AMCs, some time back. But it's a good acronym. So basically, VICTER. That's what Victor is. It is essentially to let the investors know or other stakeholders know what are the various things that are important as far as passive investing is concerned, particularly ETFs, as I said, right? V stands for volume. We just spoke about it. The
Correct.
higher the volume, it's very, very important, for liquidity to be high, and it has a lot of other implications. So that's the volume part. And the other part is impact cost. IC stands for impact cost. In a way, it's related. Volume and impact cost are kind of directly or rather inversely correlated. Higher the volume, lower will be the impact cost. But this has a direct bearing on your returns, net returns, right? If because volume is less, impact cost is more, your returns will be lower. So this is something that you need to keep in mind. Uh, T is tracking error. Tracking error, we spoke about it some time back. So again, tracking error has to be low. And this again, as I said, all these things are related. If the volume is low, if the impact cost is high, your tracking error will be high, and vice versa. All things are linked to how operationally well run a particular ETF is, how popular that ETF is, and all of that has significant implication as far as returns are compared. So that's the T. And finally, ER is expense ratio. Generally, as I said, ETFs and index funds, passives generally tend to have lower expense ratio. That is also one of the considerations for investors to invest into passives rather than in actives. We again spoke about it, but don't be only be guided by expense ratio. Don't go for funds having the least expense ratio, saying that look, I get the benefit of lowest expense ratio. You should also combine it with the other factors that we spoke about. Even if expense ratio is the lowest, if the other operational metrics are not good, for example, volume is not good, you will end up losing in other ways in terms of higher impact cost and therefore lower net returns. Therefore, you will have to look at all of these things in combination together: volume, impact cost, tracking error, as well as expense ratio. Expense ratio is also important. You should not opt for funds where expense ratio is very high, right? So a combination of all these things would be a good starting point for you to look at a particularly ETF. A lot of it could also be applicable for index funds as well. So that's the Victor framework, Nishant.
Great. So with that, we have come to an end to this interesting session. Thank you so much, Arun, for your time and inputs.
Thank you very much, Nishant. A pleasure talking to all your users. Hope they find it useful. Thank you very much.
And finally, I thank each one of you for being such a wonderful audience. Have a great day at work, guys. Bye.